everyone, and welcome to a special Investors Business Daily installment of Barron's Live. It's Coram here. I'm Executive Editor, Multimedia at IBD, and I'm joined today by my colleague, Ken Shreve, Senior Markets Writer on the IBD team. And today we want to talk about market timing signals in uncertain times. And it seems like, Ken, that's what we're dealing with right now. Not only do we have war breaking out in the Middle East, but these concerns that have continued to linger over sky high interest rates, inflation, what's the Fed going to do? So there's a lot of uncertainty out there. So we're going to take a look at some examples throughout history of uncertain times in the market, what happened, and use all of those historical examples to help inform where we are today. So to kick us off, Ken, let's just set the scene here. And why do you think it's important to study markets of the past?
Well, we have seen, first of all, good morning, Ali. Nice to be with you again. Been a little while since I've been on Barron's Live. But yeah, I think the first thing investors are told all the time that it's impossible to time the market, picking market tops and picking market bottoms. We've actually found the exact opposite through decades of research at IBD. So in other words, market bottoms look a lot alike, just like market tops look a lot alike. So the same types of things happen. You tend to see a lot of negative headlines. Just uncertainty across many different fronts. And when the headlines are the most negative and conditions seem to be the most dire, that is when we see market bottoms put in. So we're holding out hope that we could see a tradable rally here before the end of the year. Indexes currently are under a lot of selling pressure, and a lot of leading growth stocks really getting taken to the woodshed here. But we'll bottom just like we have in the past, and we'll be able to recognize the signs of that happening.
Exactly. So when it is an uncertain market, it seems like there are fear fueling headlines, and that can be the decision-making point that investors will lean on, what those headlines are. And we're going to take a look at some headlines or events throughout history and how the market reacted to show that it's important to follow price. If you just let the headlines dictate your portfolio moves, you could miss out on big markets. Right now, we're seeing not only the news flow negative, price action also negative. We'll circle back at the end to where we are in the current market and what our outlook is and what we're looking for. But let's start out with some historical examples. And you talked about decades of research, Ken. So the first example comes from the early days of IBD founder Bill O'Neill in the 1960s and the Cuban Missile Crisis.
This was right around the time he bought a seat on the New York Stock Exchange in the early 1960s, and he actually founded Investors Business Daily based on profits that he made in the stock market. And one of his big winners was Chrysler back in the early 60s, right when the Cuban Missile Crisis was going on. But again, at the time, the market was showing signs of a bottom, and Bill was looking at the stocks that were showing relative strength at the time. And this is a big pitfall of investors when the market is bottoming. They're not prepared, they're not ready to take advantage of the new market leadership. But Bill knew that Chrysler was showing relative strength at the time. It was a leading price performer in its group, and he recognized that sign of a bottom around the time of the Cuban Missile Crisis, when headlines were very negative, and it turned out to be a huge winner for him.
Exactly. And so that's the other thing to keep in mind as we go through these examples is sometimes the market can turn when there's a resolution to something. So like when the Cuban Missile Crisis was resolved, that's when we got a follow through day. That's when the market really started picking up. But there can be other times where the market goes counter to what the headlines are. And by the time things are resolved, the market uptrend is already underway. And maybe that's adding fuel to the fire. We know that right now it's a very news driven environment. So people are, it seems like, Ken, holding on bated breath We saw this yesterday. What is Powell saying? And just is dissecting every word. So we could definitely see a headline be the catalyst for the next leg up in the market, but it doesn't necessarily have to play out like that. So next, let's go to the charts and we will take a look at some examples on the screen. So we're going to go from the 1960s to the 1990s and the Gulf War. So you can see the NASDAQ here, Ken, a really bad bear market, it looks like, from July 1990 to October of that year, just a massive downtrend and sell-off. But we did see a market turn. So talk to us about what went into that market turn.
Well, we saw basically a follow through day, and this was I believe October 18th in 1990, where we got that sign of strength, and you can see the first day of the rally attempt when the Nasdaq hit that low of 322.93. That was the first day of a rally attempt. 2, 3, 4, and on the fifth day of a rally attempt, you had a really big percentage gain in higher volume. Now you can see that initial pop was met by some selling. It came down and then just started working its way higher from there. But again, a lot of negative headlines this time around the Persian Gulf War. But you can see after an initial little stutter that follow through day that we saw on October 14th worked out quite nicely and resulted in a pretty strong uptrend here. So this was kind of right at the start of this 10-year bull market, the great bull market of the 1990s, when the internet stocks were taking off. Dell was doing huge business in PCs. Some of the big winners in that right around that follow through day, Cisco showing relative strength, a strong price performer, was in the process of breaking out of a nice base here, that sideways period of movement where it hit that high of 1513. The Nasdaq follows through, and look at what Cisco does. So market precedent is extremely important. We can literally go decade after decade after decade after decade and see what the market leaders look like around the time when the indexes were bottoming. And again, the most important point to remember is that they were not lagging stocks. They were not stocks that were mired at 52-week lows or all-time lows. They were stocks that were showing relative strength in the market, and just a beautiful technical breakout for Cisco Systems. Right around the time the Nasdaq followed through in October 1990.
Yeah, and you bring up some really key points, Ken. So there's kind of two main ingredients that we're looking for to follow price. One is on the index level, following that price and volume action at key turns in the market and looking for that follow through day. So strong gain in increasing volume, because that's signaling institutions are coming back into the market. That helps put our odds in our favor if we're seeing institutional money flowing into the market. That's step one. And then step two is what's going on underneath the surface. Are there leading stocks acting well, moving up ahead of these market turns, showing strength and breaking out? And not only that, do we see a follow-up on all of this? Is it just going to be one day of strength and everything rolls over again? Or do you see a continuation of buying? And if you look on this weekly chart here, Ken, there was definitely some volume expansion over several weeks to accompany that move higher here for Cisco.
Yeah, a lot of people get intimidated by technical analysis. Really, technical analysis is just the study of supply and demand, not only in the broad market and the major stock indexes, but in individual stocks as well. So again, Cisco Systems, around the time the market was bottoming, was just volume was rolling into this stock. Volume was very heavy. It was clearly under accumulation, and it worked out just to be a beautiful breakout. It rose rose up to 2263, came down to that red line, the 50-day moving average, which is a common support level, rallied from there, and then eventually, broke the 50-day, which was a sell signal. So, we have countless examples, what we call our model book stocks, of what the big market leaders look like in the early stages of a new uptrend. So the market precedent we have in spades, and I don't know if we also have a chart from Microsoft around this time, because Microsoft was a big winner as well. Right around the time the Nasdaq was following through in October of 1990.
Exactly. We have all of these moving averages converging on that 1018 follow through day with an 8% gain from Microsoft that day. And it looks like a potential alternative entry happened on 11/12 of 1990, and then another breakout area in early January the following year, and a nice move for that stock. And all the while, I'm going to take a look at the weekly chart here. We saw that relative strength line, which measures a stock's price performance versus the S&P 500, just leading and in new high ground. So another signal there that this was definitely a stock to watch.
This was right at the start of a really, really solid 10-year bull market. So the examples are countless, and it's kind of interesting. I know we're going to talk about the current market towards the end of the show, but we're going to be looking for the same signs that we were looking for in the early 90s and just throughout market history. Market bottoms look a lot alike, just like market tops look a lot alike, and the anatomy of a leading growth stock, I mean, very, very similar when the market is trying to bottom after a period of a correction or a period of institutional selling. All these market leaders look very similar from a fundamental and technical perspective.
Well said there, Ken. Okay, now we're going to fast forward to 1998. Actually, I'm going to go to 1999 on the chart, and I'm going to go back to the NASDAQ composite here. So Ken, talk to us about what we were seeing in 1998 from an index level. We got 3 legs down. That's another thing that we see throughout market history a lot of times, 3 legs down in the market. Then we finally bottomed. But what was going on in 1998 that investors were concerned about?
And honestly, where we are right now, Allie, the NASDAQ could be in the process of doing this right now, making 3 legs down. That hasn't fully played out yet. We'll touch on that in just a little bit. But here you go. There's 1 leg down, 2 legs down, and now it's threatening that break of the 13,000 level. So 1998, the headlines were pretty daunting, no doubt about it. It started with the Asian contagion, the currency crisis that really started in Thailand when Thailand stopped basically defending the baht, their currency, and then you had the failure of long-term capital management, which held a lot of Russian bonds at the time. Russia was defaulting, so not only did you have the Russia default, but you had this the Asian currency crisis. But what does the market do when the headlines are the worst? October 14th was the follow-through day for the Nasdaq, and that would look like it was on the 5th day or 4th day of the rally attempt. So things were really ugly when the Nasdaq went down to 1357, and you had that first day of the rally attempt, and then a follow-through day soon after where you had a big percentage gain in higher volume, and then some follow-on buying the very next day where it soared again. This was a follow-through day that just worked like a charm. So again, headlines pretty negative at the time, and there were plenty of stocks around that were there to help the market move higher. I think we had Charles Schwab was a great example of a stock that was showing strength and breaking out, trying to break out close to that follow-through day. And you can see it's coming out of a period of sideways consolidation. It's taking a breather, building what we call a base, just a kind of a sideways period of consolidation. we got the sign of strength in the market. And look at Schwab as one of the early leaders. And you're talking about a significant percentage gain from the breakout, because this stock was moving right around the time we saw the follow through day in October '98.
Exactly. Yeah. The week of the follow through day, it was up 17.5% for the week. And the heaviest trading volume happened that week in a couple of years. So, heaviest volume in a couple of years for the stock, breaking it out of this sideways move here. Again, relative strength line, pointing upwards, all those good elements that we want to see. Okay. And
And a lot
now
of people,
let's take,
it's just important
go
to
ahead.
remember that a lot of people, I don't want to say a lot, but I mean, at the time, it's very easy when headlines are negative, and you turn on, CNBC or whatever, however you get your financial news, and there's this steady, chorus of negativity, and the sky is falling. That tends to be the time when market bottoms are put in. So kind of, again, right now, we're dealing with a lot of negative headlines: the strong dollar, rising interest rates, worries about third quarter earnings season. So there's a lot of negative sentiment out there. But again, that could bode well for maybe a little Santa Claus rally. We'll have to see.
Yeah, I'm glad you pointed that out. And it seems like every example that we look at, it's just we can tie it to today in some way of what we're looking for or what we're seeing. So we've got broad market action that we want to look for, leading stocks, but you mentioned it, Ken, sentiment. And there's a lot of sentiment gauges out there, but trying to look at them through a contrarian lens is something that can be helpful.
Yeah, I mean, one of the main contrarian indicators that we like to follow is the weekly survey of newsletter writers from Investors Intelligence. It's an outfit out of New York. They've been around for a long time, but when they do this survey every weekly of stock market newsletter writers, and when the bullish percentage gets up to 60%, that has always occurred right around market tops. Everybody is so bullish. That's around the time the market is topping. Conversely, when you get a lot of bearishness in the market, and the sky is falling and everybody is negative, and you have just tremendously negative bearish sentiment from newsletter writers, that's the time when stocks bottom here. So it's a good contrarian indicator. And I will say, in recent weeks, the number of newsletter writers of the bulls have been increasing. It's not at that extreme level of 60, but it's over 50%. So that's kind of another mark against the market here. When you get bullish sentiment on the rise, that can often come ahead of market weakness.
Okay, back to the history books. Let's go to 2001 now, because if you're talking, well, I need to go to a NASDAQ chart here, so it'll let me change the date. 2001. Ken, what was happening in 2001? Well, we had 9/11. And actually, if I forward to spring of 02, we'll just see a little bit more of what played out here. But we saw a lot of market weakness. I mean, the dot-com bubble burst. It was pretty brutal out there, Ken. The market was taking another leg down. Then 9/11 happens, and the market closed for a couple of days. And when it opened on, what day was this? September 17th. It was a brutal couple of days there, and some heavy volume. So there was a lot of panic out there.
A lot of panic, a lot of fear. Sky is falling. People losing money. But then what happens? You get that first day of a rally attempt after an extended downturn, and then you're waiting a few days after that initial rally attempt. You want to let the short covering kind of run its course, and then you just get that huge move by the Nasdaq when it ran up close to the 1600 level. Just for an initial follow-through day, and then just more strength, volume behind the move on both of those days. So again, a sign that the market was ready to turn higher. You had the supply and demand kind of working in your favor. You had good volume behind both of those up days, and not only did you get one follow-through day, but you got a subsequent follow-through day as well that marked a pretty decent rally. And this happened not that long after the 9/11 tragedy.
And another point here is not every market bottom is going to lead to a sustained multi-year run. Once you get that initial move, and maybe this is kind of like 2023, perhaps, in a sense where we saw a very strong January and kickoff to the year. Then this spring, we had the banking crisis fears. We were able to shake that off and go on a move for a couple of months. And since July, we've been sort of in a sideways to down kind of market. So you got to kind of roll with the punches, right? Or be able to bend with the new information that the market presents.
Yeah, I mean, just because we see signs of a market bottom, it doesn't mean we're moving from cash and just putting everything into the market and crossing our fingers. We're always kind of, easing back into the market. Yes, we saw the sign of strength. Yes, we saw the follow through day. But what are leading stocks doing? Is the market, like it did in October of 1990, where the Cisco's around, where the Microsofts around, that were kind of breaking out of bases, shooting to new high ground. The more of that happening, the better you can feel about the chances for a sustained uptrend. But sometimes these market bottoms, they launch new bull markets, like it did in 1990 and like it did in 2003 as well. But sometimes you'll see a sign of strength, and there's just maybe market breadth isn't just what you'd like to see, or there's just not enough stocks out there that are showing strength and showing the type of action that we want to see. In other words, breaking out to new highs from well-formed bases. So not every follow-through day is gonna work. We know the signs to look for, but you just always have to, just kind of ease in and see if you get positive feedback after that initial sign of strength.
Exactly. Okay, so that was 2001. Now we are in 2003. And this was the year of the Iraq invasion. Now, this wasn't something that was a very sudden thing that happened, like the current situation in the Middle East with, news of a war breaking out over a weekend. So it wasn't, by the time the U.S. invaded Iraq, it wasn't a surprise that it happened. There had been kind of a buildup, but nonetheless, anytime you're talking about the U.S. getting involved in a war, like in 2003, I mean, there's a lot of uncertainty that can surround that type of news event.
Yeah, I mean, the market was not in great shape in March 2003. You can see it was just kind of on a downtrend here, and struggling to find a bottom. It made a case for a bottom in late 2002, but then it rolled over again. You just always want to keep an eye out for that follow through day, that sign of strength. And in March 2003, which marked the start of another nice little uptrend for the indexes, you had eBay and Netflix were nice gainers, but you did have a really solid follow through day on March 17th was the actual day when the Nasdaq followed through. You marked it right there, and that spawned a really nice rally in the stock market, a meaningful rally.
Yeah. So let's take a look at those examples real quick. So here is eBay. What was it doing on March 17th? Look at that, already getting into high ground. We'll go to the weekly chart just to show. So it formed a long cup with handle base, but it was already breaking out in January of that year. And so by the time March was rolling around, it was continuing its run, relative strength line, strength off the charts. So there were some signs underneath the surface, even before the follow through day, that there were some leading stocks out there to be keeping tabs on and to buy.
It can happen a little bit before the market bottoms, like you just showed with eBay, or it can happen a little bit after. So if you're seeing signs that the market is trying to bottom, and you're seeing some stocks starting to act better, moving above key moving averages, stocks with strong fundamentals, that's a good sign. I think Netflix was. We just heard from Netflix earlier this week. Gapped up on strong earnings. Netflix was another big winner in the early stages of this March 2003 2023 uptrend. Netflix, another stock showing relative strength, and really, turned into a nice winner. People who entered at the right time had a really nice gain.
Exactly. And while this wasn't a traditional entry on that 317 follow through day, perhaps an aggressive one with that volume expansion and a nice outside day and a lift off of that 21-day line. And then perhaps you could have used that heavy volume decline on either 519 or when it started showing more weakness after reversing in June of that year to get out of the trade. But there are different ways to handle this stock. Maybe you have an even longer term outlook and you were able to stay positive on the trade and weather those pullbacks to really get a huge move out of something like this.
Yeah, no doubt about it. Again, just the lesson here is when you're looking for signs of a market bottom, and you're getting encouraged that an uptrend could be far off. You want to look at the basket of stocks that you're following. What are they doing? Are they still selling off? Are they still below key moving averages? Or are they starting to show signs of technical strength? We're not going to get the exact the bottom or the exact top, but we're going to be there close at both occurrences. But when the market is bottoming, the more stocks that you have that are sort of gathering and revving their engines to participate, the better feeling you have that the market really could be ready to bottom here.
Yeah, and perhaps another brief lesson on this one is if you miss the entries on the follow through day, or if a stock looks like a leader, but maybe it's not showing a proper setup, if the market is going to have more of a sustained move, leading stocks will give you another chance to get in. And Netflix did just that. It tightened up in August of 2003 and broke out again later on in that month, and that produced a really nice move for the stock too. So maybe if traders didn't get in right at the early going, of course, we really like dipping our toe in the water if we see a follow through day to try to get a little bit of a toe hold. If the market does pick up steam, there can be further chances as these leading stocks form new bases.
Yeah, really a great example of what a proper base looks like. The one that you just pointed out with Netflix when it hit that high of 28.60. When a stock forms a base, it's basically just a sideways digestion period. It's been a strong price performer in the market. Now it's going to take a breather and consolidate gains, and that's what Netflix did when it started moving sideways from 28.60. And then again, you pointed out that that technical breakout that came in really strong volume, and that really was the fuel that made this stock move quite nicely in 2003.
Okay, couple more examples. So reset once again to the NASDAQ and go forward to 2009. This was another March follow through day, this one happening on March 18th. And of course, 2009, we were going through the 2008 financial crisis and trying to come off lows from that. But the financial crisis was another period of uncertainty for investors, to say the least.
Yeah, to say the least. Yeah, it was a really tough time for the market. Hard to believe it was all the way back in 2008, 2009. But the banks were, the housing market was crashing. The banks were failing. It was really tough times. But the Nasdaq hit that low of 1265, and like clockwork, we got a follow through day for the Nasdaq on March 18th. Was the follow through day there, March 17th and March 18th. Yeah, so again, Nasdaq hits that low of 1265. You're looking for the first day of a rally attempt, and then you want to see that sign of a bottom. At least 4 days after that initial rally attempt, and that's what you got with the Nasdaq Composite with one solid up day and volume, and that marked the start of a nice little uptrend as well. So they all look a lot alike. The follow through days don't work 100% of the time, but we know that every single market bottom that we've seen throughout history has started with that sign of strength of the follow through day that we like to see.
Okay, let's see. We want to take a look at some examples here of the big winners during this period. BKNG, which at the time was Priceline. Look at this trending stock. And on the follow through day, it didn't move a lot on that actual day, but it was setting up. And then, as you mentioned, Ken, you're not going to get the breakouts right on the day of the follow through day. Some of them happen in the days and weeks after that. So on 4/2, we got an entry here and a really nice run for Booking. Baidu, another one at the time, Ken, that was looking good here.
Yeah, great how you can go into MarketSmith and change the date and just look at all the precedent. This is what helps us make, kind of informed decisions about underlying market health. And Baidu was just another strong price performer. Again, these stocks, Booking and Priceline at the time, Baidu, these were not lagging stocks in the market. They were stocks that were showing relative strength with good RS lines. And look at Baidu in March 2009, right? Just a perfect breakout here. Has been a big winner. China names very difficult in the current market, but Baidu at the time had great fundamentals, and it was in the early stages of making a big move here.
It was. And two more quick examples. Apple, very similar looking chart action. Maybe the entry around the follow through day was a little less clear for something like this, but it did pull back around the 50-day, could have offered you a chance, or that first fully fleshed out base then happened that summer for the stock.
Yep. And a strong price performer in its industry group at the time. So it really pays to look at the quality merchandise in the market when you're trying to assess a market bottom. And the quality merchandise are those stocks that are leading price performers in their industry group. They're not the laggards stuck near 52-week lows. I mean, these stocks obviously can go up, but if you're focusing on relative strength, these are where the big gains can be made in the early stages of a new uptrend.
Yeah, no doubt. Amazon, another one, looks pretty similar. We don't have to spend a ton of time on this one, but look at that, really picking up steam. I'm assuming that was probably on earnings in October of that year, but it bottomed well ahead of when we saw that eventual follow through day. And now we're going to fast forward in the market to 2016 when we were dealing with Brexit, Ken.
Yeah, the UK wanting to leave the Eurozone, that caused a lot of fear in the market about how would this affect the worldwide economy? Would there be slowing growth? And so the headlines were pretty negative around Brexit at the time, but I think it was July 8th in 2016, where again the market had just come through a really difficult period. The Brexit concerns were fueling some selling. Nasdaq went down to 45.74, and then when things were most negative, well, you got that first day of the rally attempt, and then maybe the short selling kind of ran its course, and then you got that follow through day right there with a nice percentage gain in higher volume. That was 1, 2, 3, 4, 5, 6, 7. Looks like 7th or 8th day of the rally attempt, which is right in the sweet spot, and that fueled a great rally for the Nasdaq as well.
It did. And now let's go to COVID. So a little bit more recent example. And I think what this one shows, and we'll point out the exact follow through day, but traders who were in this market know how explosive the gains were and how trending it was. But at the time of the follow through day in early April, it was April 6th here for the NASDAQ. So we had the bottom And then this one took a little while here, but 4-6 was the follow through day on the NASDAQ, Ken, where we finally got that volume pickup that we wanted on a solid gain. But if you would have been looking at just the headlines, if you would not have been looking at this chart, the headlines would have told you to be out of the market.
Absolutely, absolutely, and you kind of highlighted that follow through right there. It came a little bit later than what we like to see, but it did come with some volume. And this was right at the beginning of COVID. It's not like COVID had been running its way through the economy. This was in the the first half of 2020. But that follow through day for the Nasdaq, and again in our big picture column, which is sort of our daily market analysis, where we're kind of analyzing supply and demand, just gauging market health on a daily basis. On that follow through day is when we turn our market outlook to positive. So we put the market in a confirmed uptrend when we see that follow through day. So it's a green light to start buying, but it's not a green light to be super aggressive. But this follow through day in during the 2020 first half of 2020 launched a really nice gain for the Nasdaq as well, and the leading stocks were a dime a dozen at the time. I think Nvidia started to move. One of our examples.
Pull it up here. Yep.
Doing a great job going through these charts, Ellie, as usual. Yeah.
Thanks,
so look at
here it is.
look at Nvidia. So we had our follow through days in early April, and Nvidia is just in a nice little base here and starting to break out with some volume. So would have been nice to pick up Nvidia at that time. If you had recognized that the market was bottoming, this was actually a pretty easy hold from that initial buy.
Mm-hmm. It was a couple of others during this time to take a look at. Adobe, very similar base structure there. Amazon, look at this breakout here. I mean, essential needs, right? We were all stuck in our homes. We needed to get things delivered to us. So Amazon definitely in focus at that time. Microsoft formed and broke out of a double bottom in spring 2020. Apple once again also breaking out in late April 2020. Zoom, of course, this was another stock really in focus at that time that we leaned on heavily to get work done.
Yeah, it was. There were a lot of big movers in 2020. So I hope that people watching have seen that you can actually glean a lot from market history and market precedents. A lot of these stock market bottoms look a lot alike, and frankly, right now we could be near a time where we could be seeing signs of a bottom again. We're going to probably let the selling run its course, but if we start to see stocks setting up again, that it could make us feel comfortable about maybe a rally in November and December. We'll have to see.
Yeah, and I just want to make one more point about the 2020 market, and then let's dissect today and show folks where we stand. But and tying this back to one of the themes of today's talk, and that is about negative headlines. I remember when the Nasdaq was getting back to new high ground, and there was a financial news network that I will not name, but they had a segment that they were doing at that time that was called Markets in Turmoil. So again, you're going to see the crowd in times of uncertainty leaning one way when it's the price action could be doing something totally different. And so the headlines are important, but it's the market's interpretation of those headlines or how it's looking ahead that really at the end of the day, that's what's going to make us money. It's not the headlines, it's the price action that's going to make us the money.
Yeah, I mean, if you're paying attention to the headlines throughout market history, you're missing a lot of bottoms, and maybe sometimes just kind of late to the party. So it's just important to recognize when sentiment gets very, very negative, and frankly, the market is dealing with a lot right now. But you just really want to you just don't get too bogged down by the negativity and the headlines. Instead, just learn to practice your supply demand analysis. Again, a lot of people get really they get turned off, or they just say, well, technical analysis, it's reading tea leaves. But technical analysis is really just all about supply and demand, and that's what the market is all about. It's just assessing supply and demand. And frankly, when indexes are moving, you like to see them moving and expanding volume to the upside, and then when they're pulling back, you want to see that pull back in light volume. Just very basic concepts here. Sometimes it doesn't work that way. Sometimes the index is going up in light volume and then falling in heavy volume. And those types of situations, we definitely get defensive and understand that supply and demand is not working in our favor. So here we are looking at the NASDAQ, right now, testing the 13,000 level. And we looked at that recent example. Is the NASDAQ going to make a third leg down here? You had the undercut of that 13,161 level when it went down to 12,963. And now the NASDAQ is kind of waging a battle here at 13,000. So if we get a decisive break of 13,000 and even below 12,963, that long-term support level, the 200-day moving average, is a key level to watch. But that could be around the time where we'd want to start looking for that first day of a rally attempt. And again, these things need to play out first. I mean, NASDAQ could ultimately hold support here at 13,000, but market's kind of at an inflection point at this point.
Yeah, it is. And I just quickly want to walk everyone through the follow through days that we saw this year. The first one was on January 6th. And that one, Ken, we were still very close to the bear market lows. So once again, if you were just kind of thinking, oh, is this market really going to go somewhere? I don't know. If you would have just dipped your toe in the water and followed the market signal, that would have led to a nice move in the market. Then scaling back exposure, of course, was definitely warranted in that February, March area where we had the banking crisis concerns. Then I believe it was 329 that we had another follow through day. Then we had a sideways period here, almost broke below the 50-day line again. But then on May 10th, another follow-through day signal that led to a nice multi-month move. This is where it gets a little tricky. Now, not every follow-through day works. It's a signal that can help put the odds in our favor, but it's not a sure thing that works 100% of the time. Not every follow-through day leads to a sustained uptrend, but every sustained uptrend does begin with one of these follow-through days. So we did have some false signals here. 829, this was a follow-through day, but this is where okay, well, what happens next? Or what are the stocks acting like underneath the surface can be really helpful because that one failed. And then we had another one on 10/6, and this one, we're about to close below the follow-through day today. We're on track to potentially do that and undercut the rally entirely. So again, they don't all work, but it is something that can help get you back into the market after shedding your exposure, and can be that first step to seeing those breakouts and adding more exposure and making sure that you don't miss the market when it does move. Because if you think, oh, well, we've seen a couple of failed follow through days, there's no way that this next one's going to work, that's probably the one that is going to work.
Yeah, I mean, so right now, like I said, with the NASDAQ, it's kind of holding 13,000. We call that a round number. It tends to be a support level, but it remains to be seen if it's going to hold or not. My gut tells me that if there's a shakeout here, we're just going to want to start looking for the first day of a rally attempt, and then look for that that big percentage gain and higher volume, 4, 5, 6 days after that rally attempt, and then again see how is the market? Are there more bullish technical setups to choose from, or is it still kind of slim pickings? I will say there's been a lot of technical damage done to the market in recent weeks. A lot of your big market leading growth stocks, a name like Elf Beauty, I mean, the market has just gone over, has just been hitting the leading stocks left and right, and it was a bad break of the 50-day moving average for ELF. It's holding kind of a longer term support level here, but a lot of leading growth stocks have flashed sell signals, and the selling may take a little while to work itself out, but always want to be on the lookout for signs of a bottom, and just as we've gone over today, lots of precedent out there.
Yeah. And then in terms of, I guess we'll just wrap on the couple of catalysts that we could see from here. We've got a big week for earnings season next week with a ton of the major tech players issuing their results. Who do we have? We've got Meta, we've got Microsoft, we've got Amazon, we've got Google, and a ton of others. And particularly those Magnificent Seven stocks do have big weightings in the major indexes. So if they can get some upside momentum, seems like that could help boost the market. But again, we want to look at those other stocks too and how they're acting. Are they moving up with the other names if we do get those positive reactions to earnings? Also, the Fed and headlines related to the war in the Middle East, anything positive on both of those fronts could be some catalyst for a Santa Claus rally, Ken.
Yeah, I mean the market tide clearly is flowing decidedly negative right now, but again, that means it's time to start looking for signs of a bottom here. And yeah, there's a lot that needs to be resolved here. Rising interest rates and a strong dollar is typically not a good recipe for a bull market. To see gold outperforming like it's doing, so the interest rate outlook is still a little bit unclear. I think the way the market is acting right now, it's still concerned about perhaps a sharper than expected slowdown for the economy next year. But again, incoming economic data is going to help us decipher that. But what the market needs is for interest rates and the U.S. dollar to start bending lower to provide a little bit of relief here. So maybe that Santa Claus rally will come again. November, December tends to be a typically seasonally decent time for the market, but certainly a lot of headwinds out there right now.
Yes, there are. So when it comes to a potential market bottom, even if we are seeing oversold levels or a lot of fear in the market or a lot of bearishness, that doesn't necessarily mean that the market will turn. Oversold markets can get more oversold. Sky high interest rates can get even more sky high. That's what we've seen lately in this market, just relentless there. So instead of just making assumptions based on what you think could happen, that's where these follow through days can really help us focus in on, is the odds in our favor here, that we're seeing the institutions which have the power to fuel the market, are they actually putting money to work and putting skin in the game? That's what we need, and that's what we're looking for.
Yeah, I think right now, our leaderboard model portfolio is only about 25% invested, still holding a long-term gain in Meta Platforms, which reports earnings next week. So like you mentioned, it's a very, very pivotal. We've been focused on interest rates and the strong dollar and the war between Israel and Hamas, and now we've got third quarter earnings season that is gonna ramp up, and hopefully no negative surprises there. But we'll continue to watch the market here. Feels good to be sitting in a pretty healthy cash position on leaderboard right now, and we start to see renewed signs of accumulation in the indexes. I think we'll be ready to act.
All right. Well, thank you so much, Ken. And thanks everyone so much for tuning in. If you want more insights from Ken and I on IBD, make sure to check out IBD Live, where we are breaking down the market action and leading stocks every trading day.